Hello everybody, welcome to our market update video. Today is Friday, July 6th. We wish you all a happy 4th of July. My name is Gary Luna. This is Grant Haddon. Adam Carlini is actually on vacation this week, so we wish him a safe and happy journey back from Utah where he's visiting family. And with the summer months, probably a lot of you are visiting family around the country, so we hope you're having a safe and enjoyable summer. Very hot here in the Phoenix area. We hit 115 yesterday, but it's supposed to cool off down to as low as like 102, 101 for the next week. But a lot to talk about. We haven't had a good update for a while, so we hope to get into it today.
Yeah, a lot of stuff happening in the stock market this year. 2017 was an amazing year, and 2018 has been a bumpy ride so far. We've done pretty well, and we expect the year to start to pick up here, but we'll jump into the charts and show you what we're talking about.
All right, folks, good to be with you. Again, we're Dynamic Wealth. My name is Gary Luna, and we're giving you the update for July 6th. Today is Friday. A reminder that for the summer months, because many of our better clients are traveling and won't be back in town until about September-ish, so we're holding off on our more formal events, one of them being the Investments for Breakfast that you have come to be familiar with as to what we do, and that is here in the office in our conference room. Remember, we do that every couple weeks, usually on Tuesday or Wednesday, but we'll start up again in about September. And so when you get back in town, look us up, and we'd love to have you here in the office. Let's give you a couple key points as we jump into things, and this is really coming from TD Ameritrade, which is the main platform we use. And we're going to look at their second quarter ending report as they look at the economy and give their forecast for the quarter coming up. Basically, they're saying that the U.S. economy is going forward fairly well. In fact, overall GDP for 2018 should finish somewhere around 3%, maybe slightly less, but that was revised recently from about 2.7. That's a good improvement from last year that finished at about 2.3 for 2017. So that's a good sign. Remember that stock markets usually don't fall apart unless there's a recession. So as long as we have growth, even though it's not growth of 4%, growth of 3% is still very healthy from where we've been in the past few years. So that's a good sign that the economy is still doing well. Along with that, the unemployment rate continues to be fairly low. In fact, we're going to see that the recent report that came out today shows a 4%, ticked up just a little bit, but still very good. If people are employed, then obviously they're spending. Along with that, the Federal Reserve is raised short-term rates, which we'll talk about here in a second, and it's expected they'll raise at least one more time, maybe a second time, right? And it's forecast that we'll probably be close to about 2.5% on the federal funds rate as we get to the end of the year. And as we look forward to 2019, overall GDP, again, as reported by TD Ameritrade, should be somewhere around 2.8%. which is, again, fairly solid from where we've been in recent prior years. So let's talk about things more in detail. So, again, this is the unemployment report that came out this morning, again, Friday, July 6th, and we'll give you the highlights. Overall, the actual numbers of jobs that were created, 213,000. That is up from the general consensus of about 190. So that is obviously very positive, and the stock market reacted positively to that. They were surprised to the upside, which is great, and overall the markets did fairly well, anywhere from about a quarter, depending on the index, up to over 1% on the tech-heavy NASDAQ. Unemployment rate ticked up a little bit to 4%, but that's okay. And the reason why was you had many more people that were basically looking for jobs recently, which is great. So more people feeling excited about the job market and their prospects to find employment. And again, as we said before, as people are employed, they'll spend, right? And spending is at least 2/3 of the economy, which is great. One of the things that everybody's talking about is the so-called trade wars. So this is an article that came out from Market Watch, which is a great source for all things economy, stock market. And basically this came out today. And what you should know is, as reported by them, that the U.S. and China imposed levies of about $34 billion on different products and goods today, And yet the stock market kind of just brushed it off, which is great. We love that. Hopefully the market is beginning to price in their concerns about what could happen. But by way of educating you on what's going on, this article did a great job of giving some information. So you can see here, this is what the U.S. is imposing on other major economies like China, South Korea, Mexico, Canada, Europe, on things like washing machines, solar panels, steel, aluminum, and you can see the rate that they're imposing anywhere from 10% up to as much as 50%. And in reply to that, you can see where the European Union is imposing on certain products back to the U.S., obviously Mexico, and Canada to the U.S., India to the U.S., China to the U.S. So basically what came through is they both imposed in various products about $34 million in tariffs on each other, of about 25% that was imposed. So the concern there is that rates or prices could rise on those things, that could spur more inflation, right? That could be troublesome. It really remains to be seen exactly what is going to happen. I think it's a good sign, actually, the stock market, at least the U.S. market, has held up relatively well since the news broke about tariffs. In fact, I put together this chart trying to find out how the markets have been doing. So really, as of March 1st of this year is when the news started to come out from the current administration as to what they were going to do. So here is the New York Stock Exchange, which is the biggest exchange in the world, obviously the biggest in the U.S. as well, as compared to the Shanghai Stock Exchange, which represents the Chinese stock market. So as you can see, the U.S. market has held up much better than has the Chinese market. Now, let's make sure we're understanding what we're looking at. We're not saying that this is all driven by the tariffs. Obviously not. There are many other factors that have gone into price action for the market. But it's a good thing, I think, for the U.S. market that we've held up better. That might begin to tell us that it's more concerning for the Chinese than it is maybe for U.S. investors as to what's going on with tariffs. But something to be watched. Obviously, we'll continue to watch what the market does in reaction to that. And also, getting back to interest rates, last time the Fed met, which was the middle of June, they did raise their short-term rates, their target rate for the federal funds rate, by a quarter of point, right, from 1.5 to about 1.75 to 2%. And basically what they said, and this was the commentary that came out, but I'll give you the highlights, is they basically said that we expect to probably raise rates at least one more time, if not twice, throughout the year, right? And that's because the economy is doing fairly well. Also, unemployment fairly low as to their expectations, and the concern for inflation might be starting to pick up with things like oil going up, which would drive commodity prices. If tariffs continue to pick up, prices could go up there, interest rates go up, and so that's kind of the general chain reaction of things. Here's the expectation of short-term rates. This is what the Fed says they're going to do over the next few years into 2019. This is reported by JP Morgan, which they do a good job with their research. But notice, here's what the market believes, right? Market expectation. This is what the market believes is going to happen. So the market doesn't quite believe that the Fed is going to be as aggressive as they're kind of saying they are. And the reason why is they haven't been over the last few years. So it remains to be seen what they actually do. But you should note at least rates in general going up for short term and on the longer term scale, which we'll see here in a second. With that, I'll go ahead and turn time over to Grant, and he'll give you the market update and get into the charts as far as the stock market. And then
all right, well, now that Gary has walked us through the economy, let's jump into the stock market. All right, here is our first chart. It is the 4 major financial markets over the last 2 years. So, if you'll notice that what is on top, it's stocks. And stocks has done very, very well over the last 2 years. But surprisingly, you'll notice this line here is where 2018 starts, right? And from 2018 on, which we'll show you in more charts, a little bit more in detail, but it's been kind of sideways. We've been in a consolidation period. 2017 was great. Just kind of went straight up all year. Ended up closing the year over 20% on the S&P 500. But if you look at all this other stuff, commodities for the last 2 years, barely up, about 3%. The dollar has been up and down and currently is down about 2%. And the most surprising one is bonds. I thought bonds were the safe place to be. Well, actually, over the last 2 years, bonds are down about 9.7%. So, definitely stocks are still the best game in town, but this year it's been a little bit bumpy, especially in comparison to last year that was so good. So let's take a step back, though. Let's not get nervous about this year just yet. So here's the S&P 500 over the last 20 years. So here's your big drop in 2000. Here's your big drop in 2008. And you'll notice for the last 9 years, things have been going great. And we've had a couple periods that have been a little sideways and bumpy, and it's looking like we're in another one of those, at least for the first 6 months of 2018. So let's zoom in a little bit and see where we are. So here's the last 4 years, and you'll notice we've been in a trend line ever since that big drop we had in the beginning of 2016. That was about a 10 to 15% drop. Ever since then, we've been in an upward trend for more than 2 years, and right now we are on the bottom side of the trend, but we're still within that trend. And so that's a good sign. That shows us that things would most likely move forward from here and start to tick back up to the upside. Here is zoomed in again. So we went 20 years, then we went 4 years. Well, here's the last year, right, of the S&P 500. Again, the end of 2016 or 2017, very strong. 2018 is been in this yellow box here. It's really a consolidation period. We see this quite a bit. When we have a lot of gain, well, the market needs to kind of digest that. And that's what we're seeing right now. Now, the nice thing is we are near the top of this range that we've been trading in. And even better, we're actually close to all-time highs. I mean, this has been a bumpy year, right? But still, we're only that far away from all-time highs, the highest the stock market's ever been. So all in all, we've had a pretty good first 2 quarters of 2018, considering the massive gain that we had last year. Here's the Treasury note. This is actually pretty significant. We know you could draw this chart back to the early 80s, and the yield on the 10-year Treasury note has been coming down for about 30 years, really. Anyways, we just recently, and it's fit within these 2 trend lines that whole time. Well, just recently, we finally broke out of this trend line. Gary alluded to it. He talked about interest rates and how many times they have raised rates this year. And we're seeing some of the effects of that there. So that's one of the reasons why bonds are getting hurt. It's because interest rates have been going up. And expected to continue to go up, by the way. So this is just a zoomed in chart of what we just looked at. So as you could tell, 2017, kind of a flat year for interest rates. 2018, though, pop on the interest rates, which means that's one of the reasons why stocks struggle too. When you have rising interest rates, it's kind of a headwind to stocks and to bonds, really. And so another reason why the market has struggled a little bit this year. Here is oil over the last 3 years. Pretty interesting, right when we all wrote oil off that it would be done forever. Well, it's one of the only things in 2018 that has had a really good year this year. So just something to keep an eye on. Keep an eye on oil. Here is some of the major markets year to date. So here's the S&P 500 up about 3% year to date. The Dow is flat. The NASDAQ, look at that, up basically 11.5%. Small caps up 7.5%. So that's why in most of our models we hold a technology position, small caps, and the S&P 500. We hold those in almost all of our models. What is doing bad? Well, international emerging markets not doing very well, actually down about 8.5%. That's why we don't hold any international positions currently. We don't like some of the unrest that there is overseas right now. The dollar up a bit, commodities up a bit, REITs pretty flat, 10-year treasuries pretty flat as well. So where are we allocated right now? We are still above our yellow line, which means we are in the green bullish zone. Remember, here's our speedometer, so we're still in this green zone, which means we are in the most aggressive allocation that we will be in our core, in our ETF core models. So here we are. If you're a growth client, you're 100% in stocks and risk at this point. If you're a moderate client, you're 80% in, 20% defensive. And if you're a conservative client, then your allocation is 60% in and 40% conservative at this point. Here is our sector rotation model. Pretty interesting because it's been such a bumpy year. You'll notice all of the sectors and industries that are in gray, they are all not eligible. They all get knocked out by our below 6-month moving average rule, right? So because they're beneath their 6-month moving average, we don't want them. They get kicked out of our model. And so all these ones that they ranked decent, well, they still are ineligible until they get back above their 6-month moving averages. So we only have 5 active positions: consumer discretionary, technology, healthcare, real estate, and retail. And these are the 5 holdings that we hold. We hold them in 12.5% each, and then the remainder is defensive, treasuries, and short-term bond positions. So we're a little over a 60-40 in our sector rotation model right now. If things continue to pick up, then we expect this to become more aggressive and to have 8 full positions in the market running. All right, thank you so much for watching our video. Please give us a call if you have any questions or send us an email. We would be happy to walk you through what's happening in the markets right now. Thank you so much for watching our video. We will let you know. Obviously, don't make any major financial decisions based on this video. Please consult your financial professional for help with those things. We're simply giving an education on what we see in the stock market. Thank you so much for watching, and we will do another video soon. Have a great day.